Picture this. Every digital footprint you leave in the banking world, every tap, every swipe, every bill paid at 2 a.m., every save, every wish list item clicked, isn't just a moment. It's raw signal, a quiet orchestra of facts that, when combined, sings an intimate portrait of you. AI sits in the conductor's chair. First, let's map the data landscape. Banks collect transactions, balance histories, payment frequency, merchant categories, card not present behaviors, login times, device fingerprints, location signals, searches inside the app, and even how long you linger on a loan calculator. Add to that demographic data, credit bureau records, and, in some cases, third-party data like loyalty program behavior or e-commerce purchases. Each of these dimensions is a brushstroke. Alone, a brushstroke is meaningless. Together, they paint a portrait. What does AI learn from this portrait? It learns patterns and intent. It recognizes that a cluster of small, frequent purchases at baby stores, plus recent searches for maternity insurance, likely signals a major life event. It sees that recurring nights of low balances and increased cash advances might be a credit stress signal. It notices that you suddenly open investment content after months of saving. That's a potential goal shift from safety to growth. These signals feed machine learning models that infer preferences, risk tolerance, and timing, not by reading your mind, but by analyzing what you've already told the bank through your behavior. But it goes deeper. Modern models combine transactional features with behavioral features. How you navigate the app, which offers you ignore, which educational content you read to completion. They merge short-term context, a sudden spike in grocery bills, with long-term trends, habit of saving 15% of income, and then predict next best actions. That's how AI stops being reactive and becomes proactive. This is already real. Banks and fintechs are deploying these systems to deliver micro-personalized nudges, from an alert suggesting a better savings rate to a real-time offer for a small business line of credit tailored to your vendor payment. These systems analyze customer journeys and risk profiles to generate product recommendations and timely advice that are far more specific than a generic email blast. The technology stack looks like this. Data ingestion pipelines pull transaction streams. Feature stores transform behaviors into model-ready variables. Prediction engines compute propensity scores for actions. And decision engines decide when and how to surface an offer, push notification, in-app card, or an educational article. The models are judged not just on predictive accuracy, but on business lift. Did the customer open the account? Did they increase their savings rate? Did churn reduce? Here's the spine-tingling part. AI systems can do micro-segmentation at scale. Instead of young professionals or retirees, AI slices populations into thousands of behavioral cohorts. One cohort might be early savers who occasionally gamble on stocks. Another, subscription-heavy users who prefer autopay. Each cohort receives a different script, a custom product, an optimized interest rate offer, or a tailored financial wellness nudge. That's micro-personalization in its purest form. And it feels almost like the bank knows you. But how accurate is this portrait? It depends on model quality, data freshness, and feedback loops. Good models get feedback, whether you clicked, accepted, or ignored an offer. That feedback retrains the model, improving future personalization, unless the feedback is noisy or biased. Which brings us straight into the terrain of bias and false inference. A model may overfit on a correlated behavior and then incorrectly deny a product because it misread the signal. The consequence is not just a missed sale, it's customer mistrust and potential regulatory scrutiny. Now imagine someone malicious slicing those same data sets. That's why banks invest heavily in data security, access controls, and model governance. But even with safeguards, national authorities and global regulators are waking up to the systemic implications. Central bankers and financial stability boards have flagged that heavy reliance on sophisticated AI systems can amplify vulnerabilities. Imagine many banks using the same model or vendor, and a single model flaw triggering widespread mispricing or a sudden wave of identical recommendations that destabilize markets. The risk isn't hypothetical. Regulators and central bankers have already warned about the potential for systemic fragility if AI is misapplied across the financial system. So, what does the bank actually know about you? More than you might expect, but not everything. It knows patterns and probabilistic signals. It can predict likely goals and nudge toward them. And every nudge, every prediction, is the result of a game, the AI's game, to convert prediction into a product, and product into revenue. Understanding that game is the first step toward taking back control, which leads us, in the next segment, to how banks actually convert what they learn into offers, and what you should watch for in privacy and consent. How banks use it, privacy and consent, and a real-world use case. If the first act explained what AI learns about you, Act 2 is the reveal, how banks convert those learnings into action, and the hard trade-offs involved. This is where recommendations, pricing decisions, and product nudges become the bank's primary tools. Banks use a blend of propensity modeling, life event detection, and real-time scoring to decide which product to show, to whom, and at what time. Propensity modeling calculates the probability you'll take an action, say, open a savings account with a higher yield, based on historical behavior in similar customers. Life event detection flags major changes like marriage, pregnancy, or a new mortgage. Real-time scoring combines both with current context, a low balance, a pending rent payment, or a flagged support chat asking about loans, to surface the next best offer. The output is often a multi-channel play, in-app banners, personalized email, a chatbot proactively suggesting a budgeting plan, or a push notification with a pre-filled loan calculator. For businesses, this feels like magic and efficiency. For customers, it can feel either helpful or eerily prescient, depending on how it's done. Finally, a short industry reality check. Banks are racing to monetize personalization because it drives engagement, product adoption, and efficiency. But regulators and central bankers are not sitting on the sidelines. Warnings about model concentration, systemic fragility, and disinformation-driven runs have already been raised by major authorities, underscoring that personalization at scale is powerful and risky at the same time. The balance the industry must strike is simple, if not easy. Unlock value for customers without trading away privacy, fairness, or financial stability. AI in banking can be a brilliant assistant. It can spot life events, propose smarter products, and nudge you toward better financial choices. But it's also a tool that needs rules, transparency, and your attention. Ask for control, read consent setting, and treat every helpful recommendation as a choice, not a command.